So what I'm going to do in this webinar is something maybe some of you are familiar with. You have seen the Africa's Pulse. So Africa's Pulse theme this year was on jobs, creating jobs at scale in Africa. Actually, Justice is one of the key authors of that report, especially the jobs section. So in principle, you should be giving this presentation. But what I'm going to do is basically just give you a brief overview, and then we can have a conversation around the proposals that we're making here. The first part is, of course, something you're familiar with. You've probably, those of you who are here during the annual meetings probably have had me speak about this or have attended the State of the Africa region and have seen it. So it shouldn't be something completely new, but I hope that you will still learn a few more details with this presentation. All right, so let me start with, so how do I remove? Sorry. Okay, there we go. We're just adjusting our screen. So let me give you, first of all, the context of this jobs challenge, and then we can talk about the jobs challenge. And, you know, as I give you this context, of course, you should recognize that this is something that is Africa-wide, sub-Saharan Africa-wide, but of course, your own countries have their own contexts that are maybe a little bit different than this. But nonetheless, I think you would see a lot of familiarity here. So the first thing is that despite all the uncertainty that we witnessed this year, right, on trade, on geopolitics, on conflict, and all kinds of things that have kind of been particularly disruptive, African growth remains resilient. So you can see, for example, that we've actually upgraded the forecast to 3.8 from 3.5% last year. And our projections seem to indicate that if nothing really bad happens, which we hope nothing bad happens, of course, as always, that the growth rate might actually accelerate to 4.4%, which would be close to what we've experienced the first half of this century. I mean, yeah, exactly. The first 20 years of this century, right? So that's good news. So that is a reflection. And you know, the interesting thing is that, you know, the growth, these upward revisions are broad-based, right? It's 30 out of 47 countries in sub-Saharan Africa. We've upgraded their growth focus upwards, and it includes some of the large economies like Ethiopia, like Nigeria, you know, like Cote d'Ivoire. So this is not a trivial thing. Now, what's driving? Okay, so let's go back. What's going on? Yeah. So what's driving these growth rates? Well, I think the first thing is, and this is maybe something we should all be, you know, you should all be congratulated. You should be proud of yourselves as policymakers, right? So the first thing is that the region have been very successful actually at maintaining low levels of inflation, right? So the inflation levels, you know, in 2020, only 3 years ago, were really worrisome. But those things have come down the last couple of years to less than 5. Now the median inflation is around 4%. That doesn't mean that every country is experiencing 4%, but most countries are actually having inflation rates that are within the bands that the central banks actually accept. And even the ones that are double digits are beginning to decline. And you know, inflation is coming under control. What that means is that the central banks now have some space to be able to reduce interest rates, the cost of capital, the cost of borrowing, the cost of credit, right? And of course, that is also good news for businesses. It's also good news for households, because then it actually is supporting consumption and it is actually allowing for recovery in investments. It's not, the investment recovery is not fully there, but it is beginning to edge up. So that's important because that is an indication of economic activity rebounding back. Okay, so that's the story now. And on trade, it hasn't been nearly as damaging as we thought it would be, right? So when in April, when the Liberation Day tariffs were announced in the United States, you can see, for example, on the right-hand side of this graph, how really high the uncertainty rose, right? It was really a spike. That blue line you can see there is basically, the levels of uncertainty that were created when this disruption happened. Since then, I think, there's been a little bit more clarity about, what the tariff rates that the United States is imposing look like. So since August, I think things have come down a little bit, but the uncertainty remains because they keep changing, right? We don't really know where this is headed. But at the minimum, for Africa, at least why the trade uncertainty hasn't been nearly as damaging as we feared, is because of three things, right? One is that African countries in general are not very exposed to the US markets, right? Only 6% or so of African exports actually come to the US market. There are much bigger trading partners that would be worrisome if this were to happen, and that would be Europe and China. Okay? And then the second reason is that a lot of the things that African countries actually sell to the United States, such as oil and gas, minerals, are exempt from those taxes anyway, from those tariffs, right? And then on the third reason is because the tariffs that were imposed on most African countries, there were exceptions, but most African countries were on the lower side of the global tariff regime that the United States imposed. So most African countries were hit with 10 to 15%, which is the lowest band of tariffs. Now, there are exceptions, of course, like a major economy like South Africa was hit with 30%. And then there were, of course, also, concerns with, countries like Madagascar and a country like Lesotho, where garments, and even Kenya, where garments constitute quite a bit of exports to the US, and those exports were, of course, harmed by these tariffs, right? But that is the reason why, in fact, the things that we feared about these trade disruptions haven't completely materialized, right? Now, we're not completely out of the woods, of course, in this macroeconomic context. One is that AGOA has ended, African Growth and Opportunity Act, which is the quota-free, duty-free kind of arrangement that the US had with African countries. So that has ended in September. We don't know when it will be renewed for how long. The European Carbon Border Adjustment Mechanism, which taxes goods on the content of their carbon content, is going to be fully implemented next year. So some of the, and that is important. That is much more important, in fact, than anything else, because Europe is a major trading partner for the continent. In addition, there are a lot of other things happening, right? ODA is declining, right? So for a lot of countries where ODA was a major financier of social services like health and education, that would be, that there will be a lot of disruption and pain. Debt services remain high. So African countries, almost, the number of countries that are either in debt distress or in high risk of debt distress have gone from 8 to 20, almost 23, right? So almost tripled, right? And that's almost half of the countries in sub-Saharan Africa, right? And then because a lot of these countries now don't have a lot access to international financial markets, many of them are resorting to domestic debt. And domestic debt tends to be very expensive and also very short maturity, right? So these are the risks Now, it's in this context, trade uncertainty, ODA declining, debt service remaining high, composition of debt shifting to domestic debt, which is more expensive. And of course, you add on to that these whole issues around, the quality of our institutions when it comes to issues around security and so on, that you find yourself in this big elephant in the room, which is the jobs challenge, right? And the jobs challenge is unlike anything any other region in the world has ever experienced, right? So the graph on the right, or actually on the left, let's look at the one on the left, is the net change in working age population for each region that the World Bank usually classifies as a region, right? And you can see that Africa stands out in ways that are very obvious, right? So there will be an additional 625 million working age populations by 2050, in the next 25 years in Africa. The closest region that comes, the next highest region is MENA, Middle East, North Africa. And that's, basically maybe 1/3 of what Africa is experiencing, what sub-Saharan Africa is experiencing, right? And this is, you can see, for example, for some countries in Africa, large countries in Africa, what this means. So Nigeria will add almost 1 million additional working age population in the next 25 years. Congo will be next with 72. Ethiopia is 67. Even Uganda will add about 27 million additional workers, right? So you can see these are going to be some, rapidly growing countries. And the region as a whole will be rapidly growing, right? So that's one real challenge. It's just the sheer number of people who are coming into the working age population who are seeking jobs, who need jobs, right? The second challenge is that a lot of these people, when they come into the labor market, actually do find something to do. They do work because the labor force participation rates are very high, right? 70%, both for men and women. But only 24%, only a quarter of those people actually find wage employment. The rest of them are working in low productivity and informal employment, which does not provide, any prospects, any hope for, income growth, social mobility, getting out of poverty, and having some status and esteem and dignity in order to be able to participate in social life, as we all hope we do. Right? So this is the second challenge. So, and the reason why this is the case is because, as you all know, African farms are small. They start small, they remain small, and therefore they don't create jobs at scale. Right? So these are graphs that we've that kind of demonstrate that point. On the left is the share of micro establishments across the life cycle of a farm, right? So, for example, on the horizontal axis is the age of the farm. On the vertical axis is the share of micro farms by age group at particular ages of the farm. So if you see, for example, we have this comparison between a few countries in Africa and the USA. So for US, which is the solid black line, by the time a farm is about, I don't know, like a decade into the farm's, the beginning of the farm, right? When the farm was established, a decade into the establishment of the farm, if you took the cohort of businesses that were established, within 10 years, right, half of them have exited being small. They've become more like medium and large. Half of them. By contrast, in Africa, more than 90%, around 90% or more remain small and micro. Okay? And then by the second decade after these companies have been founded, in the US, 80% of those farms are no longer small or micro, right? By contrast, in Africa, 80% of them continues to be that way, 80% or more, right? So that's what the graph on the left shows you. Now, if that is the situation, you can imagine if that is the case, and by micro, we are basically defining micro as businesses that employ less than 4 persons, right? So you can imagine that it's really impossible to create jobs at scale that are going to be desirable, that provide a certain level of income that gives people career mobility and so on and so on. And you can see that on the right. You can see that employment rates for this cohort of companies in Africa are basically hovering around 20% of what a similar kinds of companies in the US have created after these many years, right? So, even starting small, they are 20% of jobs that the US companies start, and then and then they continue to be that way for decades, right? So that's why our argument here in this report is to say that Africa's growth model going forward absolutely cannot be based on these micro enterprises. All right, you have to start thinking about policies that encourage medium and large farms to enter and small farms to grow, right? Some way we have to find some way to make sure that these small farms actually find, we remove the constraints that makes these small farms remain small so that they can grow into medium, and then the medium can graduate into large, because that's where the jobs at scale gets created. That's where specialization takes place. In medium and large farms, that's where technology adoption is more rapid. That's where productivity growth happens. That's where wage growth happens, right? So that is the key. Now, so the question becomes, how do we actually make sure that the farms expand, right? And therefore create jobs at scale. So we provide, here this framework, which basically has 3 foundational issues and specific actions under each one of those foundational issues that needs to be taken in order to then create an outcome where, you have this transformation taking place, right? So let me just go through quickly. So, one of these foundational issues is, of course, what farms need is infrastructure. And there we mean specifically, both physical and soft infrastructure. But by physical infrastructure, it's something you're all familiar with, which is, energy, digital technologies. These are general purpose technologies where, modern economies cannot function. Modern farms cannot function without them. Of course, we also mean transport networks. That could be, ports that are functioning, airports that are functioning, roads that are, that are high quality, and so on and so on. But also human capital, right? Skilled workers that have some know-how that come into the labor market with particular kinds of training that they can then use in order to be able to make farms, more competitive and therefore more productive. Then the second foundational issue is business environment. This is something about competition and, level playing fields, policies around entry, issues around access to finance. How much does it cost? Is it easily accessible when the farms need them for specific kinds of activities where they need to expand? Macro stability is critical, and so is trade. And then finally, this idea that you need to create an environment where there is some security, there's stability, there is some predictability of the environment, so that farms can invest for long term and medium to long term, right? Now the whole idea of this framework is to say, if you fix this foundational stuff by taking these specific actions, and the concrete actions for each country for under this, right? Then what happens is that you end up creating conditions for farms to grow and expand and create jobs at scale. You get these farms to enter particular sectors that then get transformed, and productivity growth happens in these sectors, and then job creation happens. So that's the whole idea. Okay, so let's just look at specific examples. How much time do I have?
15 minutes.
15 minutes. Oh, okay. That's plenty. I'll finish shortly. So, so physical infrastructure is really, really important. And here we want to give you a couple of examples of these two general purpose technologies, energy and digital, and then transport. If you ask African firms, African enterprises, what are some of the major constraints to their expansion and growth? Energy comes top of the list, and then the next one we will see shortly is access to finance. And 71% of businesses in sub-Saharan Africa experience outages, right? The key thing here is reliability of electricity and the cost of electricity. And then Justice have done some work which shows that if you just take outages, you look at all these outages that are really frequent in Africa, and you estimate in each one of these countries where there's frequent outages, what the cost to job losses are, it's 5 to 14 percentage points. Forget about creating more jobs. In fact, the existing jobs get destroyed if you don't have a reliable electricity. And then the other thing is that it's just costly, right? We all know that, in fact, in many cases in Africa, a kilowatt of power costs about 20 cents, while in competitors in East Asia, it costs 7 cents, right? Like it's 3 times as expensive in Africa to have access to electricity. In addition, before you even come to reliability issues, right? So it's extremely difficult for firms to think about how to operate in that environment, right? What they do then is, they have to spend a lot of money on generators, import fuel, and that is all the money that can't go towards basically hiring people, right? And expanding their businesses, right? So that's one. Digital technologies are actually relatively more, in terms of coverage, they are relatively more common because they are mostly driven by private sector participants. But the problem is because there's very little competition, given the regulatory environment there and monopolies, it's very expensive, right? The high cost of digital devices in sub-Saharan Africa is, say compared to the US or any other, pick other places, is about 35% more, right? Internet bandwidth is expensive. And we know that, in fact, if you lower these costs, that you end up increasing employment, right? We have studies that show that employment from access to fast internet in a bunch of African countries, that's Nigeria, Tanzania, and several others, goes up by 5 to 7%, right? So, and the key thing here is that, a lot of these countries, because this thing is very expensive and because the products are not really they're not really designed for particular context, productive use is very low, even though the coverage is available, even though the coverage is very high, right? 80% of African businesses and households live within an area which is served by, 3G networks and above, right? But only 22% of them use these networks for productive use, right? So there is a lot of scope for these businesses to actually begin to use this digital technology. And then, of course, you're familiar with transport, right? 24% of farms identify transportation challenges as major constraints. And transport is just costly, right? You've had all these stories that tell you that sometimes it is cheaper to get goods from China to a port in Africa than traveling from a port in Africa to some inland city, right? It's very difficult to be competitive and to expand as a firm if you are facing those kinds of constraints. Then we come to the conducive environment, which is, issues around access to finance. If you want to start a business, do you have money to, people who can take risks on you? And how much does it cost, right? So many of you are familiar with our countries where interest rates are in double digits. Now, if inflation is also in double digits, that's that means basically that then that washes out. The interest rates are very low, but in some cases that's not the case. Inflations are like 5%. Interest rates are like 13, 14%. That's massive. It's huge. Real interest rates are really high, and a lot of these startups, which is what we want. We want existing business to expand. We want new businesses to enter. A lot of these startups cannot bear debt, right? So if the interest rates are very high and they have to have regular cash flow to be able to pay that, they can't afford that. What they want is equity financing, which is something they don't have to pay upfront or on a regular basis, but somebody can take risks on them so that they can develop their business and can burn cash very rapidly in order to establish themselves in the market. And that is not very common in Africa. Equity financing. Instead, 80% of all startups in Africa are financed from outside. And usually of course, you can imagine, it's usually to specific kinds of sectors, that are very sexy with outside financiers, right? Fintech, things like ICT and so on. But things like, agro-processing, machine manufacturing or something like that is probably not something you will see a lot of financing for. So that's one. And then you have an environment that is really, really difficult for a lot of countries, businesses in Africa, right? If you want to register a company, it can be, days, and then so many licenses and loopholes that you have to actually overcome. So, we estimate, for example, that the average cost of starting a business in Africa is 42% of GDP per capita. That's really, really expensive, right? And then 16% of firms say that they pay bribes. And so imagine all these costs, right? This is money that the firms cannot spend on expanding their businesses, on hiring people, right? On improving their competitiveness, on adopting technologies, on improving productivity, right? So think about the cost of these things, right? It's very costly. And then firms, in order to expand and for new firms to enter, need a market. A lot of markets in Africa are tiny. Countries of 10 million people, 5 million, 6, 13, 20, right? If you're a very ambitious firm, you want to be a big firm and you want to enter a market, you want a market that is much larger. You want a market access. And in Africa, domestic markets are not going to be sufficient, right? So you need a continental or a sub-regional market that's large enough where there's not a lot of friction. And that too is a work in progress in Africa. At the moment, only 13% or so of trade is intra-African trade. Other regions are in the 50 to 70%, right? So that's another constraint that we need to overcome in order to create jobs. When it comes to these infrastructure issues and foundational issues, of course, we also cannot, imagine a world in which you cannot think about the importance of human capital in terms of well-trained workers, right? So this is the first time that Africa, I would say, is changing the relative ratios of land to people, right? This is a continent that has been underpopulated for centuries. This is the first time that it is beginning to close that gap with the rest of the world in terms of, population densities. And so when you have that kind of change between, in terms of just population, concentration, you would expect that, in fact, a lot of your growth is going to be driven by the capabilities of your people, not necessarily how much land you can exploit or, how much more forests you can destroy and so on, right? Or how much more mining you can do. It's more like, what's the capability of your people now to be able to create new products, new innovations, and so on and so on. And that's why it's so important to invest in, human capital in Africa, because now the continent has the the right size of population to be able to drive foundational growth and job creation, right? So that means you have to create this ecosystem. Early childhood investments in nutrition, in stimulation, and so on. Foundational skills on numeracy and numeracy and what's the other word? Reading. Sorry. And then, of course, you also, there are sectors that will be growing. We'll see them shortly. You also need to invest in sector-specific proficiencies in skills, right? So there are these fast-growing sectors like, agro-processing or agribusiness, tourism, maybe even mining in some places, right? So you need technical skills for, people with technical skills out of TVETs who can be able to actually be absorbed in these kinds of sectors and can bring skills in those sectors. And then beyond that, of course, is advanced saturated level education. Now, those are all the credential skills, but then there is non-credential skills that we need to think about, things about, socioeconomic, socio-emotional, modulation and skills, teamwork, problem-solving skills, entrepreneurial skills, managerial skills. All those things they're not hard, skills, and they can't be credential, but they're really, really important for functioning of firms and competitiveness. Finally, for this foundational stuff is the importance of, peace, curbing corruption, efficient delivery of services, right? I mean, when you see a lot of young people in Africa and their dissatisfaction or restlessness, it comes down to these questions of governance, right? Delivery of services. When there's no electricity, they can't really begin to, work on their dream projects. There's no water, they can't, so and so on and so on. And you see that in all these conflicts, all these uprisings that you see in Madagascar, in Tanzania, in Kenya, in Uganda, Nigeria, Morocco now, and so on, right? So you need a state that can deliver peace, stability, both political and macro, is inclusive, right? Really takes seriously its role as a regulator, and of course, provides services that are necessary for businesses and individuals to thrive, right? So that's very important. Unfortunately, when you look at the graph on the right, the quality of regulations in sub-Saharan Africa or institutions in general are much weaker, and that need to be strengthened, right? Okay, so if you fix all these foundational issues and you take this action and do what are the sectors where which are jobs rich? And we obviously there are a lot more sectors than this one, but this is a starting point, especially for a continent like Africa, right? Agribusiness is one of those. Agricultural productivity remains low. If you raise agricultural productivity, and in the report, we actually provide specific things you can do in agriculture to raise productivity, then what happens is you move a lot of those people to employment in midstream and downstream. This is, by midstream, we're talking about processing, warehousing, transportation networks, all kinds of services to both the upstream producers, farmers, but also the consumers, right? That's the midstream. And only 19% of jobs right now in agri-food system are actually in this midstream and downstream. That has the potential to go much further, right? 24 million people right now earn their livelihood through tourism and hospitality, right? 24 million. You know how many people actually visit just Paris in a year? It's like, what is it, 50, 60 million people? The size of the entire population of France, right? So you can see there is enormous scope for jobs to be created at scale for a continent that large, if there is a lot more mobility and movement for people to visit these countries, right? So again, tourism is one of those, it's one of those jobs which cannot be displaced by international competition, right? These are jobs that are created locally and domestically. Same thing with healthcare. There's a lot of scope for like increasing the number of doctors, nurses, midwives, community health workers, because this population is growing and there's going to be a lot more demand for healthcare services, right? Similar thing with housing. Population is growing, cities are expanding. There's a lot of demand for housing. But with housing comes all kinds of other industries that support housing, right? You need, businesses that create or that produce windows, doors, iron bars, toilets, what do you call them? Machines, like washing machines and so on. So like there's just a whole industry around that. Even though, we think of a house, but there's a lot of stuff that goes into a house, and that requires an ecosystem of an industry. And, you can see how many units are needed, by just 2030 alone. So that's a massive job creation machine that if African countries can really focus on it. Mining is a tricky one, right? Mining itself is very, capital intensive. It doesn't really create a lot of jobs, but the revenues from mining can be invested in all the other sectors to create that create jobs. So improving the agri-food system or agribusiness from the revenues, using it for housing and construction, using it for healthcare, healthcare expansion, and so on and so on. So that's it. So open for questions.